how does a CRUT work? So what do you do here? What's the point? As we said, the whole point is to get an asset into the trust so that the IRS views it as being sold by the trust. And that's important because it's the trust that is tax exempt, not you. And so if you sell an asset at the extreme end, if you just sell the asset and receive the cash and then put the cash into the trust, the IRS would say, no, that's your income. That's not the trust's income, so it's not tax exempt. At the extreme other end, if you put an asset into the trust and wait 10 years and then sell it, of course, it's the trust's asset and the trust's gain. And so that gain is going to be tax exempt if you put it into an IRA. Where the rubber hits the road here goes to Mike's question and Rahul's question. What can you put in here and when? And the principle is, in general, the farther before the sale you put the asset into the trust, the better. We're not here to do a deep dive into legal doctrine, but I'll just point out that the IRS has litigated this a lot, and it's very fact specific. But the basic idea is you need to put the asset into the trust before it's been committed to sale. So what does that mean? With something as fungible or as flexible as public stock or cryptocurrency, it needs to go in before you've hit the sell button, right? That's easy. With something like a private business, it's tougher to tell exactly when it's been committed to sale. We've worked with a number of clients of big tech companies whose companies have been who entered an agreement to sell, a private sale. And then there's been Department of Justice review, or the deal's been paused because the buyer got cold feet or there was a contingency. The board had questions or the shareholders had to approve. These are all relevant data points. We don't have to go too deep into it. If you have questions, schedule a call and we'll talk in more depth. But in general, if you're selling public stock or cryptocurrency or some other very flexible asset, it needs to go in before you sell. If you're selling shares in a private company, it has to go in before the sale has been approved. So before the shareholders and the board have voted yes. If you're selling a closely held business, like a small or medium business that your family owns, it typically needs to go in before you've signed a purchase and sale agreement. Probably it's not too late if you've signed a non-binding letter of intent, LOI. We prefer if you do it before then, but we recognize and the law recognizes that's hard. And so probably it's fine to do after your LOI, but you definitely want to do it well before you've actually signed on the dotted line for a binding sale. Even if you're not closing for months or years, it's got to be before you've signed and agreed to sell. So what happens after you move the asset into the trust? The first thing that happens is a bonus. You get a deduction. You get typically, although there's some moving parts here, in general, you're going to get around a 10% deduction on the appraised value of what you put into the trust. So if you take $1 million of Apple stock and put it into a CRUT, you're going to get a $100,000 deduction on your personal taxes this year. That's totally separate from the tax-free sale, which we'll talk about. It's just a bonus. And the reason you get this is you're committing typically 10% inflation adjusted to charity way down the road. I'll talk to Eric's question about giving to charity and when in a minute, but you're giving money to charity way down the road. And so you get a deduction today. That's a nice bonus. If you put $1 million in, you get a $100,000 deduction. That might save you $50,000 on your personal taxes. Super valuable. After you've taken that deduction, the next and the biggest thing that we've talked about here is that tax-free sale. You put the stock into the trust, you sell it, and instead of paying in California sometimes as much as 30, 35%, or in New York or some of these high tax states, 35% in capital gains tax on the sale of that asset, or even more if it's a short-term capital gain, right? If you get a short-term capital gain, you might be paying 50% plus. You're deferring any tax that you would have owed on that sale. And so instead of paying, let's say, $350,000 out of your $1 million sale, you pay zero, and you get to reinvest that full $1 million. And that's huge. You get to grow it, reinvest it. Typically, you get to reinvest it however you want. There are some small limitations. You can't trade on margin. You can't take out a mortgage inside the trust. But in general, you can invest in stock, crypto, private companies, collectibles, real estate, whatever you want. You can grow the money for many years. We'll talk in depth here, but in general, you get to take out every year between 5 and 15%, depending on how long the trust is expected to last. So if you put in $1 million, you might get an annual distribution between $50,000 and $150,000. You can defer that amount. We'll talk about different formats of trust in a minute. You don't have to take that liquidity. And for many of our clients who are younger and want to compound for longer tax-free, they leave the money in there. And we'll talk about how that works. And then at the end, you leave whatever's left in the trust after all of your distributions and when the trust ends, which might be after a fixed term, it might be after your lifetime, it might be longer. You leave whatever's left in the trust to a charity that you've chosen.
I have a question there, Jeff. Okay. Do you have to decide the charity before settling up the structures or not?
Good question. You don't have to commit to the charity until 6 months after your trust ends. So if you have a term trust that goes for 20 years, you have 20 years and 6 months. And by the way, you can change your mind. You can name a charity and then choose someone else down the road. You can name multiple charities. That's easy. That also goes to Eric's question, which I want to mention. What portion can you give to charity yearly? Can you change the amount? How much is deductible? With a CRUT specifically, as opposed to other kinds of charitable trusts, it's really important to note here. What's happening is you're not actually giving money to charity yearly. You're saving that up and you're leaving behind at the very end of the trust a lump sum for charity. You can give out of trust assets if you want to. You can give an additional amount to charity every year or whenever you want to, and that's great. You're not going to get an additional deduction because you've already pledged that 10%, and now it's the trust that's giving to charity. There's no additional deduction, but if you want to accelerate your giving, you can certainly do that. While I'm paused here, let me just hit a couple of these questions. Rahul asks, can highly appreciated options contracts go in? Generally, option contracts, yes. Not startup options, which are a little bit different, in incentive stock options or non-qualified stock options, but an option on Tesla stock, for example. I'm thinking of a client that we just did a CRUT with. Yeah, you can move an option contract into the trust for sure. Ian asks, in the case of a private business sale, can a client just put part of the ownership? Yeah, absolutely. And this is true no matter what kind of asset you're putting in. You have control and you can move part of the asset. So if you own 1 million shares of stock, you can put 1 share or 1 million or anywhere in between. If it's a private company, you can divide it up. You sign a document, a transfer agreement that says, I am giving 25% of my ownership to the trust. Great. And that works fine. The only difference is now the cap table, the ownership roles have the trust on there in addition to you. Otherwise, it's no different than it would have been otherwise. Calvin asks, would a long-term capital gain get converted into ordinary? No, that's really important. Good question. And the answer here is, in general, the distributions retain the tax treatment that they would have had outside of the trust. So if you sell stock that you've held for more than a year, that's a long-term gain. When you distribute that money, in general, it's going to be taxed as a long-term gain, which is great. You don't give up that treatment. There's some nuance to that. There's something called the 4-tier accounting system, which you might want to go read about. If you just Google Valor and 4-tier accounting, you'll find a good article from us. The idea is that actually what happens is the highest tax money comes out first. So if you have short-term gains and long-term gains, the short-term money comes out first. But in general, part of our job at Valor, and we'll talk about what we do here, we set these things up and we manage them for you. We do the accounting. Part of our job is to advise you to make sure that you're tax optimal in terms of your investments and distributions so that you're paying that lowest tax rate possible. Calvin also asks, can the charity be a private foundation? Yep, for sure. It can be a private foundation. It can be a public nonprofit. To Yasir's question, if it's a public charity, it does have to be a U.S. entity, either a 501c3 or a private foundation. If it's a foreign entity, as long as they have a U.S. entity to receive the donation, you can do that. Ian asks, can an investment advisor who's paid by the client to manage their assets also be paid by the trust to manage its capital? Absolutely. The trust can hire service providers, including a financial advisor, an accountant, a trust administrator. That's our job. And it can pay you as long as it's market and the grantor, the trustee who sets up the trust, agrees to pay you. Totally, you can get paid out of the trust. That's totally fine.